as we were talking off camera, the real issue is there seems to be something missing. Okay, we know that there's not a systemic issue slowing the economy, but we are buffeted from some slowing globally, but we just don't seem to be going back up to 3% growth. What is it that's our impediment, you think?
I think the first thing is what's still there is consumer spending. I mean, consumer spending, with or without autos, we're still at 4% types of growth rates in retail sales. But what is missing and has been missing is the acceleration of capital spending from mid-single digits to something higher that gets us and keeps us above those 3% growth levels. And you know, that capital spending, the rates remain relatively muted. I think it's because there is slowing globally. There's also uncertainty about trade and what the whole trade dynamics are going to look like for the next few years. And that, to us, it's a recipe that we're going to be in on this soft landing, growth slowing in the U.S., but we're not going into a recession, and we're going to end up at something that's looked very similar to what it's looked like post-crisis, you know, 2% plus or minus
Now, there's
GDP.
a lot of theories that it's a lot of other things as well. But, you know, when you turn the heat up on a pot of water, and the heat being turned up is U.S. normalization. The globe is creating less stimulus and saying basically sink or swim on your own. So as we turn up the heat, everything's moving faster, but as we were discussing, none of this should surprise anybody. These are all normal events during a rise cycle. You see all kinds of things, usually spreads move, so that isn't out of the ordinary.
Yeah, no, and I think what the market is wrestling with is the Fed has been on this normalization path, and we knew it was going to bite at some point, and we were going to see the slowing, and I think we've figured out that we've reached that level where it's having the spillovers back into the real economy. But you know, as we were talking about, we think the Fed gets the message, and you know, I think that's been the message from Chairman Powell.
Doesn't mean they're done. It just means that they're going to wait and see how what they've done thus far affects the strategy of more normalization.
Yeah, and it's the Fed's moving to something where they're going to be a little bit more, as we were talking about, data dependent, off the preset quarterly hike cycle. And that's one of the ingredients you need for, you know, we think, stability in the markets.
And you brought up a healthy consumer. Last week we had consumer credit, and for the third time in 4 months, it's over $20 billion. Okay? So there's a good pace there in every regard. So my final question for the final minute's an easy one. Capital spending isn't like an option in that pit, where after so many days, it's gone, it dies, okay? It will be ongoing, and there's no real limit. So when conditions change and visibility for CEOs change, it's possible that capital spending is going to be another boost, is it not?
Yeah, look, capital spending, as you know, it's one of the most volatile categories in the GDP accounts. And, you know, once you got a good base of global growth and, you know, spending in the U.S., I think you just do need to resolve some uncertainties about where China and European growth is ending up, and then some of the trade issues. You know, there are positives for the second half of the year and, you know, maybe even into the spring.
So you know, Steve Leisman on our channel has pointed that it's been very difficult to pull out how some of these trade issues are having direct effects. But really what we're discussing is a very big indirect effect. If you have little visibility, you're not going to commit your wallet. Your final thought.
Yeah, no, I think that's exactly right. With these uncertainties, where do you build that plant? And you do need to see some resolution. But the underlying, this is a big economy, and it's fundamentally, we think, you know, in decent shape.